This is Mark to Market, a podcast of BT correspondents.
Hello everybody, welcome to Mark to Market, a BT correspondence podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of September 2025, and one segment of the market that's been making headlines recently is the telecommunications sector. That's largely because last month, on the 11th of August, before the market opened, it was announced that M1's telco business would be sold to Simba Telecom, the smallest of the four mobile network operators in Singapore. Now, the market had been speculating about the sale of M1 for months because M1's parent group, Keppel, is in the midst of a major multi-year transformation program that includes the monetization of a slew of non-core assets, including M1's telco business. However, up until the morning of August 11th, many market watchers were expecting that it would be StarHub that would purchase M1. From an operational standpoint, StarHub is much more established than Simba, and let's face it, like M1, it's controlled by companies under the Temasek umbrella. Of course, Singtel is also ultimately controlled by Temasek, but Singtel is such a big group that acquiring M1 wouldn't have moved the needle quite as much. So when it emerged that Simba, rather than StarHub, would acquire M1's telco business, lots of analysts and investors had to quickly rethink their views on the telecom sector, and it seems to me that they're still getting to grips with what it all means. One outcome of this deal, that seems quite obvious, is that there will be fewer players vying for customers once Simba subsumes M1. Some analysts have said this industry consolidation could lower the competitive intensity across the sector, which would help support profitability at all the telcos. Another view that has been expressed is that the combined Simba-M1 entity may struggle with integration issues, which might result in StarHub as well as Singtel capturing most of the spoils of any reduced competitive pressure in the industry. In short, there is a view out there that maybe StarHub dodged a bullet by not being the one to acquire M1, and maybe it'll be a beneficiary of the industry consolidation without having to bear the risk of a big acquisition and a complicated integration process. My own view is rather different. The way I see it, once Simba acquires M1, it's going to be a pretty fearsome competitor. It'll be a much bigger player, of course, and it will have two telco brands in its fold, targeted at very different segments of the market, which could put it in a strong position to take the fight for market share right to the door of its more established competitors. In fact, the share price action in the telecom sector since the deal was announced suggests the market is much more excited, for now anyway, about Tuas Limited, the Australian Securities Exchange-listed company that owns Simba, than it is about StarHub. On the day the deal was announced, StarHub shares suffered a 4.9% sell-off. Tuas Limited's shares were actually halted from trading the day Simba's acquisition of M1 was announced, but the following day, on the 12th of August, they jumped 29.6%. And Tuas Limited shares have climbed even further since then, which is remarkable given the boatload of money the company is raising to finance the deal. Now, I'll talk more about the financial aspects of the deal and the outlook for the telco stocks later in this podcast, but let me first get into the larger theme of this story. I think it's probably fair to say that Singapore has a lot of faith in the idea of market competition as a driver of economic growth and prosperity. It makes a lot of sense because Singapore has a small domestic market, and if local businesses hope to grow, they have to be globally competitive. Every now and then, macroeconomic turbulence, shifting industry dynamics, and technological change forces companies to downsize and reposition themselves, but after they consolidate, they are pushed to compete again. The commercial aviation industry is a good example. Singapore Airlines and Changi Airport strive to be the best in the world because there's no domestic market, and they wouldn't be relevant if they weren't among the best in the world at what they do. When budget carriers expanded in the region 30 years ago, the instinct in Singapore was to embrace and invest in them. It was a pretty bumpy ride, but today, SIA is still a thriving full-service carrier, and it has Scoot under its wing. The banking sector is another example. In the wake of the Asian financial crisis in the late 1990s, MAS pushed the local banks to merge among themselves in order to gain scale and become more resilient, but they weren't shielded from global competition. On the contrary, the local retail banking sector was liberalized around the same time, with several foreign banks being allowed greater access to that market. But the local banks rose to the challenge. Today, DBS, OCBC, and UOB still have big market shares in Singapore, as well as expanding regional footprints. Then there's the telecom sector. The local mobile business was still in its growth phase when I moved to Singapore in the year 2000. Everyone told me at the time that Singtel was well ahead of its competitors in terms of coverage, so I just went with a Singtel mobile phone contract. But M1 and StarHub were coming up fast and finding ways to compete with Singtel. As I mentioned in a recent mark-to-market column in the Business Times, I decided to move to StarHub after a few years in Singapore. This was partly because I wasn't too happy with the service I received at a Singtel outlet one day, but it was also because I was by then subscribing to StarHub's home broadband and pay TV services. Adding a mobile phone subscription meant more bundled discounts. Now, over the past year, I've been wondering whether it's time for another change. For one thing, almost all the TV content I watch these days is from Amazon Prime, Disney Plus, and Netflix. While StarHub has gone out of its way to make itself the platform through which I consume and pay for these streaming services, I'm not sure I'd be any worse off if I went back to accessing them directly through their individual apps on my TV. After all, that's how I use these streaming services on my laptop and phone. More importantly, there are some very attractively priced mobile phone plans available now. For instance, Simba currently offers 400 gigabytes of data, 5G network access, and unlimited local calls for just $10 a month, according to its website. In a sense, Simba is pursuing a budget carrier strategy in the telecom sector in order to compete. It's carving out a segment of what is now a relatively mature market for itself by targeting price-sensitive consumers who have not been well served by more established players. And judging from Tuas Limited's headline financial numbers, this strategy is working. The group's revenue has grown very fast over the past couple of years from a low base, and for the 6 months to January 31st, 2025, it achieved a maiden positive half-year net profit after tax of 3 million Singapore dollars. Will Simba continue with its strategy of focusing on the most price-sensitive consumers now that it's acquiring M1's telco business? Or will it change tack? Will there be more competition amongst the remaining telcos? What does it all mean for investors in the sector? I'm going to talk about that next.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Market, a podcast of BT correspondents.
One of the most surprising things for me about Simba's acquisition of M1's telco business is the market's apparent exuberance about the deal. As I mentioned earlier, Simba, or rather its ASX-listed parent Tuas, is tapping investors for quite a lot of money to finance the acquisition. M1's telco business is being acquired at an enterprise value of 1.43 billion Singapore dollars on a debt-free and cash-free basis under the deal. In the 12 months to April 30th, 2025, the acquisition target had revenues of 806.1 million Singapore dollars and EBITDA of 195.4 million Singapore dollars. On the other hand, for the 6 months to January 31st, 2025, Tuas Limited had revenue of 73.2 million Singapore dollars and EBITDA of 33.1 million Singapore dollars. If we annualize those numbers and compare them to M1's telco business, it suggests the acquisition target has revenues that are about 5 times that of Tuas Limited and EBITDA that is about 3 times that of Tuas Limited. Now, Tuas Limited's business is growing quite fast from a low base. Its revenue for the half year that I mentioned was actually up 33.7% year on year, and its EBITDA for the period was up 47.7%. But the point I'm making is that Simba and its listed parent are going to be subsuming an acquisition target that currently has a much larger revenue and EBITDA base. One thing that Tuas has going for it is a pretty strong market valuation. Even before the acquisition of M1 was announced, it had a market cap equivalent to about 2.2 billion Singapore dollars, which is larger than the price tag for M1, and for that matter, larger than StarHub's market cap. And, as I said earlier, Tuas Limited shares jumped sharply after the deal was announced, and then continued rising. So far, the stock is up more than 40%. This has helped Tuas quickly raise the funds it needs. In fact, on the 12th of August, the day after the deal was announced, the company said it had raised 385 million Australian dollars through an institutional placement of about 69.9 million new shares at 551 each. That's in Australian dollars. Tuas said, with that placement, it now has approximately 536 million shares in issue. So at its current price of 772, its market cap would be close to 4.2 billion Australian dollars or nearly 3.5 billion Singapore dollars. Now, there is more fundraising coming. Tuas has said it will raise a further 50 million Australian dollars from its existing shareholders through a share purchase plan. These new shares will be priced at the lower of the institutional placement price and a 2% discount to Tuas Limited's 5-day volume-weighted average price up to the closing date of the share purchase plan. As long as Tuas Limited's share price holds up, this shouldn't be difficult to pull off. So, is Tuas Limited going to remain the hottest play in Singapore's telecom sector? Well, this is certainly a very exciting moment for the company. As I said earlier, its revenue has been growing fast, and its bottom line had turned positive during the 6 months to January 2025. And the acquisition of M1 will definitely put it in a strategically stronger position. Tuas has also said that it expects the acquisition of M1 to be highly accretive to its earnings per share. Yet, it's impossible to know for sure how things will look a few years from now. One of the things I said in a recent mark-to-market column was that the consolidation unfolding in the telecom sector now is reminiscent of the spate of bank mergers that took place some 25 years ago. In particular, the excitement among investors about UOB after it outflanked DBS to acquire Overseas Union Bank comes to mind. Investors with very long memories might recall that the deal was projected to make UOB the largest local bank by asset size. Today, UOB is actually the smallest of the three local banks by asset size. I'm not suggesting the transaction wasn't an important move for UOB, but that over time, other things mattered too. Even in the short term, the impact of the reshuffling of market shares among the local telcos is hard to analyze. As I said earlier, my own view is that the intensity of competition will probably increase rather than decrease, at least in the short term, despite there being one less telco in the market. One question I keep hearing people ask is whether Simba will become more like M1 in terms of the market segment it targets, or whether M1 will become more like Simba. I'm not sure either of those two things will happen. In fact, they may just continue focusing on their respective market segments. Simba isn't the only telco going after market share with extremely low prices. There are several MVNOs, or mobile virtual network operators, that offer low-priced mobile phone plans by using the networks of the main mobile network operators. In fact, StarHub has an MVNO called 8, which offers mobile plans that are not that different from Simba's. The way I see it, Simba's acquisition of M1 gives it a platform to take its fight for market share to the more traditional segments of the market, but I'm not sure it would immediately allow it to price up its services. Certainly, the existing mobile network operators seem to be preparing for a fight. StarHub last month lowered its earnings guidance in anticipation of adopting a more aggressive commercial stance in the months ahead. Instead of aiming for stable EBITDA in 2025, StarHub said it would target to achieve between 88% and 92% of last year's EBITDA. StarHub said this revision reflects a deliberate strategic decision to preserve competitiveness and defend market share while continuing to invest in long-term growth levers. Also, StarHub has indicated that it plans to be an active player in the consolidation of the telecom sector. Immediately after the Simba-M1 deal was announced, StarHub said it had purchased the remaining stake in MyRepublic's broadband business that it did not already own for 105.2 million Singapore dollars. That wasn't a very big deal, but it does set the tone and suggests that the group is on the lookout for acquisitions, even as it defends market share across its businesses. So, what does all this mean for investors? This brings me back to Singapore's faith in market competition. When Singapore's fourth mobile network operator first appeared on the scene, I really didn't see how it was going to be able to carve out a viable share of the saturated market for itself. Yet, a few years on, after some intense competition that has benefited consumers, Simba is acquiring M1. Some analysts seem to be looking 1 or 2 years into the future and betting that the reduced number of players will translate to less competitive pressure, which would be positive for investors. My own view is that regulators will keep trying to foster a competitive environment that serves consumers. And after this period of consolidation, the remaining players won't be allowed to rest on their laurels for too long. Now, some telcos may create value over time by investing in other markets or by getting into adjacent fields such as cybersecurity and cloud services. But I think investors have to assume that there will always be intense competition for certain commoditized services, such as SIM-only plans, where the telcos will have to keep delivering value in order to stay in the game. For me, Singtel is the only player that looks interesting right now. It has broad exposure across the region, including in fast-growing markets like India, and it has been actively unlocking value for investors. The stock has already done very well, but some analysts are projecting double-digit earnings growth over the next couple of years and have been raising their target prices. In fact, I was just looking at a recent report by DBS that has a target price now of more than 5 Singapore dollars for Singtel shares. The outlook for StarHub isn't quite as exciting. A number of analysts recently cut their earnings forecast for the company because of the more cautious guidance that I mentioned earlier, and a lot could depend on the intensity of competition a year from now, which to me looks rather uncertain. On the plus side, recent reports from Maybank and CGS International are projecting dividend yields of about 5% for StarHub, and their price targets are very close to where the stock is currently trading. So, not exciting for now, but not much downside either. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwak, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening, and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.